Singapore's GDP shrank 1.4% over the last quarter, sparking calls for monetary stimulus. Joining me on the line to discuss this further is Wai Ho Leong, Senior Regional Economist at Barclays. Thanks for joining me, Wai. What does this GDP contraction mean for Singapore's economy?
Well, it's largely technical in nature. The weak data in the advance estimate is due to lower than expected manufacturing output in January and February. Electronics fell very sharply and pharmaceuticals manufacturing as well. But the signs that manufacturing has improved in March and into Q2, things will be looking up stronger. So there's hope that the economy and the manufacturing side will recover. We don't see any sense of crisis. This has been a manufacturing-led growth contraction. In fact, services activity has been strong and is doing just fine. If you look at the labour market, it's still fully employed. Unemployment is below 2%, and people are actually hopeful that things will pick up.
Singapore has stuck to a policy of allowing gradual gains to its currency even after an unexpected contraction last quarter. And the Monetary Authority of Singapore says it won't change the slope and width of the currency trading band that it uses as the main policy tool. Is this a good idea?
Well, I think it is. Even as growth is weaker, inflation is still pretty high. Inflation was 4.3% for Jan and Feb on average, and this is still well above its 10-year average of 2.6%. Keeping the appreciation stance of policy, I think, in this environment would be appropriate, given that expectations of inflation need to be anchored further, I think.
There have also been tighter restrictions on foreign workers, leading to a labour shortage and price pressures. What impact could this have on the economy?
Well, in the short term, this will gradually push up the cost of doing business in the economy over the next few years. So that means that part of the inflation will become structural. But in the long term, I think all this will be good for productivity. To put it simply, I think Singapore has been very relaxed about allowing more foreign workers into the economy in the past decade. But it seems to be hitting spatial limits now in terms of the numbers that it can absorb. And there are signs that businesses are becoming more reliant on cheap foreign workers and has reduced the incentive to invest in technology and automation. So by tightening lower-end foreign worker inflows, I think the government hopes to make firms more productive as a result. And this should be the long-term goal.
At the same time, the Southeast Asian nation's exports posted the biggest drop since 2009 in February, while industrial production slid the most in at least 3 years. What measures could be taken by the government to boost export and industrial production sectors?
Well, realistically, there's not much the government can do to boost manufacturing output. Singapore has really leveraged the global economy, and particularly to the global technology cycle. But there are some hopeful signs that both electronics and pharmaceuticals production are turning around, which will boost growth in the second quarter for manufacturing. But aside from manufacturing, it's very important to remember that tourism and financial sectors are still doing very well, and this is helping to boost the services economy. I mean, if you walk around on weekends, restaurants, shopping malls and bars are still full, even though the factories are quieter. And you can still see help wanted signs on shop windows in malls. So this is quite a testament to the very tight labour market situation that has persisted, even though the economy may have contracted slightly.
That's all for now, but stay tuned to Dukascopy TV for the latest financial news and updates. Goodbye for now.